Good morning. Thank you for joining me this morning. So, today I wanted to tackle understanding risk and the different types of risk that are out there, and just trying to make wise decisions as we move forward. So, risk management, when it comes to investing, there's actually a number of different types of risk. So, I wanted to address that first of all. One that we might be hearing about frequently right now is called interest rate risk. And the potential that goes along with that is the value of a bond. So, bonds traditionally will pay out interest. And if interest rates are going up or down, you have to be concerned about what is happening. So, if interest rates are going down, usually bond prices are going up. If interest rates are going up, then bond prices are going down. So understanding the difference between those two can be very important. So we're experiencing a time frame right now where interest rates, even though the feds are raising the Fed rate, bond prices have actually been going down because the interest rates have been going up. So that's something to pay attention to in today's environment. Another area of risk that I want to talk about is market risk. And so market risk deals with stock prices, interest rates, exchange rates, and commodity prices. All of those have to be taken into consideration. And then there's also credit risk. So I know we've talked about bonds in the past, but when a credit rating is assigned to a corporation, a municipality, a government entity, they are going to rate those organizations based on their ability to pay that interest back. So that's called credit risk. And if their credit risk goes down, meaning that they are considered to be a little less financially secure, you are going to see the amount that that entity needs to pay on its bonds going up. So credit ratings go down, interest rate that they have to pay goes up. Now that one's a little bit confusing. So if you want to talk about that in greater detail, let me know. So let's see, we talked about now stock prices, obviously dealing with the market volatility. That is market risk. So you are kind of, what's the right word I want to use there? You're kind of tied to what the rest of the investment world is doing. So if they feel strongly about a stock or a bond, they be buying more, and we're seeing more opportunities. The prices is going up. But if, let's say, negative news hits the airwaves in regard to a specific entity, you may see that the price of that particular stock or bond or whatever it might be is going down. So that's market risk based upon what other investors are actually doing. All right, so interest rate risk, we talked about exchange rate risk. So if you are purchasing securities that are outside of the US dollar, you may experience currency risk or just having to deal with the fluctuation of that currency in comparison to what it's trading at the US dollar. So if it falls in value compared to the US dollar, and you have an entity that is based upon that foreign currency, it is going to affect that investment and in its own. So sometimes when you're looking to buy a security, whether it's a mutual fund, primarily mutual funds, you can actually make a selection that they are purchasing it based on the US dollar. So you're not seeing the currency fluctuation that goes along with it. That's a little bit more complex as well. So if that's something you want to discuss in greater detail, again, give me a call. But it's also important to balance risk. So what does that mean? Many times when you're dealing with a financial professional such as myself, we talk about the term asset allocation or building a diversified portfolio. And that means having a small piece or a piece of your puzzle in different types of securities. we start with the broad base of some in bonds and some in stocks. And then we break down the bonds, whether it's municipals or treasuries or corporate bonds, whether they're high risk or low risk bonds. And then when you look at stocks, we take a look at the size of the company. Are they large companies, mid-sized companies, small companies? Are they based in the US? Are they based in large foreign countries? Are they based in smaller foreign countries? Having pieces in all those different puzzles to make up your whole puzzle can be beneficial from a risk standpoint. Also, I didn't throw in, you can have commodities, you can have real estate, you can have all different types of securities involved there. But not having everything tied to one particular category reduces the amount of risk that you have with the portfolio. So it's important to take a look at that as well. And the last tip I have, and this is the hardest one of all, is leaving your emotions at the door. Okay. It is important to come up with a strategy that meets your goals and your long-term plans for your life. Sometimes it might be short-term. And if it's going to be short-term, then you want to have something that's going to be very conservative and you don't have to worry about all these different types of risk. But if we're talking about a goal that you're trying to reach in 10 years, 15 years, 40 years, who knows how long it might be, it's important to build a good, strong strategy for your investment portfolio and stick with it, even when we're going through really trying times. Right now, the volatility that we're experiencing in the market, and I keep saying right now, so I'm just going to, today is April 15th of 2022. We're experiencing market volatility, both on the stock side and the bond side. We're not permitted in this industry to use the word guarantee. I can't guarantee anything except for the fact that it's going to go up and it's going to go down. But if you look at the markets historically, they have all moved upward. It may have been over a longer time frame. And in the short term, it may feel like a roller coaster. But if you have that ability to leave your emotions at the door, maybe not even opening up those statements in the time frames that things are more volatile, not clicking on the link to see what the balance is in your 401k because you're in it for the long term, that can be very beneficial. Individuals who make decisions based on emotion tend to sell as the market is going down or as it's reached its bottom, and they find it very challenging to purchase while it's going up because they're not sure if we've actually reached the bottom. So these are the different types of risks that we have when it comes to building an investment strategy portfolio and making sure that it's there to fit your long-term goals. So if you have any questions or want to discuss it in greater detail, don't hesitate to give me a call at 412-346-4655. Send me an email at diane@pearsonfinancialplanning.com or a direct message right here through Facebook. As always, if you found this of interest and you feel like there's someone in your life that might benefit by listening to our weekly little tidbits, please let me know. I'll be happy to send them an invitation, or you can invite them yourselves. And as always, have a great day.